to get everyone started. First, everyone, thanks for joining us today. Today, I'm joined with my friend Nick Demary. Nick, my name is Sam Erekeosima. I'm a realtor and investor, and I just wanted to give everybody a quick update on what's going on in the markets right now and what mortgage rates specifically are looking like and how you can still get a property with the current rate condition. So, Nick, why don't you go ahead and get started and tell people a little bit about what you're doing?
Gotcha. So first off, I will say thank you, Sam, for
Absolutely.
having me out here today. It's a pleasure. As we all know, that we are in one of the craziest markets, that we have seen in 15 years. And yes, it's tough. It's tough for you guys who are buying homes and you're looking to become a homeowner. It's tough for the investors who are looking to go out and continue their spree on playing Monopoly and grow their pipeline and their portfolios. And it's tough for me as a loan officer and the other loan officers across the country and around the world today that are battling through this. And right now, today, the rates average, we're looking at about 7%. Huge difference than what we initially thought that we were going to get to this quick back in January and March when the Fed announced that they were going to hike them up. But if we looked at the numbers, if we sat back and we kind of put everything into, and we stepped outside of the box and looked into the picture, we knew it was going to get to this point.
Yeah.
The Fed announced that back in March they were going to raise it 5 to 6 times, if not more. And we're at that threshold. We're coming up on it, and as you can see, we're in the ballpark of about 7%. And yes, it is putting a damper on, everybody's goals that we're looking to accomplish, but waiting will still cost. And what I will say is that in real estate, and Sam, you know this.
Yeah.
Appreciation is always more prevalent than depreciation. We know that becoming a homeowner or acquiring that property you want right now, it's not going to fall back on you and hurt you. The values, although we see the home prices dip a little bit, the values are always going to consistently rise. And by becoming a homeowner, acquiring that property and locking in, you are going to be safe. Your payment isn't going to change. Your loan isn't going to change. The market can go left, right, up, down, sideways, whatever it may be. Your product, your program is going to stay the same. And I wish us loan officers and professionals in real estate would be able to kind of put our thumb on what exactly is going to happen with these rates. But we don't have a crystal ball, and all we can do is kind of just use our knowledge and I'd like to say a lot of common sense plays a huge role in this.
Yeah.
In predicting what's going to happen and how to adjust, how to be a chameleon in this market. It's very prevalent. And basically what I will say is that with these rates, when they come down, because we know they're going to come down, it's going to open up a lot of doorways. We are going to wait, and we got to hope that the bond market shifts. Now, it's not helping us with our government today that we just are continuously spending money and getting it out and shipping it out to whatever it may be.
And for the regular people, can you explain to them how the bond market affects mortgage rates?
Gotcha. So when we see inflation and inflation starts to rise and there's more of a demand for goods and services, that is what's going to drive up interest rates. Just like when you see people going to rent, right? And nobody's looking to buy, but everybody wants to rent. That's going to affect the rent because it's more demand. So the people who own those pieces of real estate are going to jack that rent up because they know they can. It's a seller's market. It's the same. This is the simplest way to put it. When inflation rises, when the government starts spending money, when our nation is pumping a lot of money out, it is going to cause the bond market and the bond yields to skyrocket. And once those things skyrocket, we're going to see our interest rates skyrocket. So we see it with gas. We see it at the pump. We see it with food. We see it with almost everything.
Yeah.
There's not one thing I could think of that hasn't really went up besides, maybe a McDonald's Big Mac. They kind of have been loyal. But that's exactly how it works with the bond market. When inflation rises and the bond yields tend to rise, you're going to see our interest rates start to rise. And that is pretty much simplest terms how to break down the bond market.
Okay, excellent. I know for me, as an investor, when I'm looking at certain properties, I'm taking into account how much my mortgage payment is versus how much I'm going to receive from a rental perspective. I know if you're looking to flip, you're concerned about the rates because now you have to borrow the money to do the deal, and obviously the higher the rate, the less attractive the deal is, the less money that you're going to make on it. And as a realtor, as I'm looking for properties for my clients, I find that their main concern is how much can they pay every month, right? I think the average person doesn't necessarily care about the rate. They want to know how much can they afford to pay every month. So,
Yes.
And when it comes down to the rate, it's like, all right, like I think we did a quick little example before.
Mm-hmm.
Last year, rates were around, I think, 3%.
Yeah, I mean that was actually giving it a little bit of justice too. I mean, we were getting people in like the 2.5, low twos. It was incredible. Talk about a time to buy and
Yes.
and invest. So yeah, I mean, to that point, we can compare it from let's just say a 3% interest
Yes.
rate from last year to now we're looking at 7%. In New Jersey, where we're operating, let's just say the national, the state average for the purchase price for a home is anywhere between 450, 500.
Right.
So if you're looking at an interest rate of 3% on a property that's 500,000, let's just say going off of 10% down, typical average. Based on that, you would have, and then to the 7%, you're looking at about $1,000 a month in payment in a payment jump, and that $1,000 a month is hurting you in a few different ways.
So
One,
say like 3,500 versus 4,500.
exactly.
Yeah.
You know what I mean? We're looking at, if we were to go based off of the price and with 3%, you're looking at about $1,800 to $1,900 on that property.
Right.
When we were at 3% versus now with 7, looking at close to $3,000, maybe 4. And it's upwards. So it's a huge increase. $1,000 is a lot of money, and it's going to hurt you in two ways. One way, it's going to push you out of your comfort zone.
Right.
That house that you really want. When we loan officers go and price it up to the current market conditions, and we see how volatile these rates move every week, they're changing. So last week that payment was in your comfort zone. Now it's out of your comfort zone. You don't even want the property anymore. And then on top of that, even if it's not pushing you out of your comfort zone, you're like, okay, maybe I'm okay with that payment. Then you got to worry about your debt to income.
Yes.
And you could have your back against the wall, and a jump like that it's just completely detrimental, and it could close the door on a lot of things that you're looking to accomplish.
So again, rates are kind of composed of, like you said, the bond rates, the Federal Reserve setting their benchmarks. I think right now we're like between 3 and 3.25 for the federal funds rate. I believe their target is somewhere between 4 and 4.25.
Mm-hmm.
So that to me means that we may see another increase of another whole percent before the Fed is absolutely done raising their interest rates. So we may even creep up to 8 at some point within the next 6 months to a year.
Yeah, and I completely, I can attest to what you just said, and I definitely, there is that wiggle room. There's still that margin that we have, that initially when they announced everything, that we're still kind of creeping up on, and we're not seeing any stabilization. We're not seeing anything die down and balance. And with that margin still being said, like you were just saying, Sam, yeah, the possibility of us reaching 8% is very likely to happen before the end of the year. And my analysis is that I believe that hopefully come the spring market, the next spring market, 2023, I think that is when we're going to see a lot of things start to par out, and we're going to start seeing a lot of these portfolio programs and just the rates in general start to dip back to where they should be. If not, hopefully see a huge decrease in home prices.
Well, yeah, I think you just nailed it. I think the Fed. That's all they're really concerned about. It seems to me. It seems that they have focused on cutting down inflation, and their biggest tool to do that is to keep on raising interest rates. There's not a Fed meeting this month, but I do believe when we have one, I believe the beginning of November,
Yes.
where they will probably raise rates another probably 0.5% to 0.75% to get closer to that 4.25 benchmark they're looking for. And then I do expect them to hold it there for a few months. Now, it's going to be interesting to see how long can they hold it there for, like you said. Maybe around spring, they see that the economy is completely destroyed and, the jobs are lost. Because I think for the Fed, they're really more concerned about they can raise the rates as long as unemployment is not high.
Exactly.
And that's the trade-off the Fed has to deal with. When they raise rates, it lowers GDP, raises unemployment. Now, when they decrease the rates, it actually makes unemployment come down, but then you have inflation going up. So they're kind of caught between a rock and a hard place there. So we'll kind of see how that plays out in the next few months.
It's a really tough balance, that they're trying to operate with, and like you said, that is the question: how long can they hold that there, and what are the outcomes going to be? What is going to get better? What's going to get worse? But we know for a fact that it could only get worse if it doesn't.
Yeah, on my end, what I'm seeing out in the real estate market, especially here in New Jersey, is although rates are still pretty high, 7%, and we're probably going to go higher. There's still just not enough properties. I think the inventory is still an issue, which is why the prices have not come down as much. Now, what the Fed is trying to do, raise the rates, make it so almost impossible to borrow money for the regular person that they'll just say, you know what, I'm not buying a house now, which then brings the prices of houses down because now sellers will be like, well, before I had 50 buyers looking to buy the house, now maybe only have 5 or 10.
Yeah.
And now instead of getting 20 offers over asking, 30 offers over asking, like we've been seeing over the past year or so, maybe it's you're getting your asking price, and then if it sits on the market for a little while, then maybe you cut your price, which we're starting to see a little bit of that.
Yeah.
I'm seeing prices reductions. I'm seeing people getting asking prices. Now you're getting some offers below asking, and now it's up to the sellers to decide, are they willing to bring those prices down? I think if the rates stay like that, they're going to have to.
Because think about the people that have to sell their home.
Yes.
You know what I mean? There's no really way around it. And you can't even base it off of the market conditions when it gets to that point, because it's almost like, okay, if I am selling my property, I have to sell my property, and you're not getting it done. If you're in a time sensitive situation, that's really the only option you have. And we see how everything's going, like you're saying, with inventory, and a big problem is that when no one is buying, and I was saying this actually earlier, when no one is buying and everybody wants to rent, and that demand for rent goes up, then it's leaving us with no one who's looking to meet the standards and what the people are asking who want to sell. And it's drying it up. So we need to see a shift, and I'm hoping that when we reach that 4.25 benchmark, that they don't hold it too long, because no one wants to see that. As a home buyer, no one wants to see that. As people in our industry, we don't want to see that, because we're not moving forward. We're not getting what we need done. So we need to see that shift.
Now, I will say this though: if we do see in the next, let's say, 6 months to a year that rates are staying high and it's lowering buyer demand, and let's say by some slight miracle we get a little bit more inventory, then I think we will see a reduction in prices, right? And then now the people who are getting priced out, they're still technically going to be priced up because now their interest rate is higher, and they'll be paying probably the same or more than they would have before. But they're in a situation where if you can get approved for a loan at 7 or 8%, but now the price is 10%, 20% lower, in 3 years or a few years, as rates come back down, they have an opportunity there to refinance, and get into a lower rate and lower the actual mortgage payment.
Of course, yes, and that's another thing too, is if you're comfortable with it, if you're able to afford it, if your debt to income ratio works, I always say this: you marry the property, you date the rate,
Yes.
and because there is always that option and ability to refinance, and that's the thing too, is that the one of the pros to these rates going up is, and this actually applies to a lot of the investors, is that with these rates going up, we're seeing less offers already, but and thus because it's getting less competitive, and by that we're going to see what we're looking for with that shift. You know what I mean? It's going to come. We see that the inventory starting to shift. We see these home prices starting to dip a little bit. The people who are out there in the market, whether you're looking to buy a home for your primary residence, if you're looking to invest and you're trying to get an investment property going, the one pro to this right now is that competition is dying down.
Yeah, I've definitely seen less offers, less activity, and it typically starts to die down around this time of year.
Mm-hmm.
As we head into the winter months, we get a little bit less active as far as properties active availables for listings and things like that. So
Mm-hmm.
I'm gonna definitely keep an eye on that and kind of see what the market's doing. But I think the rates are the driving force, and the Fed is determined to lower inflation, even if it means 8% rates and things like that.
Yeah, and it may just be one of those things where yes, this is a 15-year high, and it's crazy, it's shocking, but we know that if we can just hold on, and if you're looking to buy that home, you have to, like I said, the biggest thing is you marry the property, you date the rate, and we know that these rates are going to come down. I don't foresee it taking any longer than a whole nother year in 2023. I think that in 2023 we're going to see them come back to where we are kind of comfortable with. You know what I mean?
Yeah, I think I'm thinking the same thing. Maybe towards the end of 2023, you'll see the Fed start to actually cut rates. I don't know how long they're going to keep it at that 4.25 benchmark, making it 8%, but maybe around this time next year they'll start actually cutting it, and then you'll start seeing the reduction of the interest rates, and hopefully at that point you also have the reduction in pricing, and now you got people who are able to not only afford the rate but also get a decent price on the property as well. Now, unfortunately, here in this area, we live in northern Jersey. I do believe that this is a premium market. So while the rest of the country may adjust 20%, 30%, here it's more likely 10%, 15%, because there's so much demand being close to New York City.
Of course.
And those wages and there and here are higher, so people can actually afford to spend a little bit more on a property. So I'm curious to see how it all plays out. But me as an investor, I'm actively looking for properties right now. So if I see any deals out there, I'm trying to hop on it, and hopefully the rate is something that I can handle and still make the deal go through.
Of course, yeah. And as an investor, Sam, and you see an opportunity, you grab it. It's not going to be there forever. And that applies for any investors that I know, that it's waiting will hurt. I've never honestly seen it, depending on it. Listen, it has to make sense.
Yeah.
It has to make sense. It has to be in your comfort zone. I'm not telling you to go pull the trigger and just, take a shot in the dark. It's got to make sense. You got to be able to afford it. And if you can't afford it, that by pulling the trigger, and it makes sense, the property makes sense, that what you're going to accomplish with this, whether if it's a short-term rental, long-term rental, if you're looking to flip, if you see that opportunity down your scopes and you don't pull the trigger, you're doing a disservice to yourself, because you can't let the rate scare you.
Well, I think you nailed it before when you said you date the rate, you marry the home. And
Exactly.
When you marry the home, that just means you found the right home, right? And whether it's this year, next year, it's the right home for you at the time. And if you plan to live there for a long-term period, whether you're getting it now at like a higher rate and things like that, and you can refinance later, it's still the right home for you.
Yeah.
Now the question is, can you afford it because of the current economic conditions? Yeah. But if you can, and it's the right home, then I would absolutely say yes, pull the trigger, because it meets all of your needs. And that's when I'm working with people as a realtor, it's like, well, does it meet all your needs? Does it satisfy everything that you want it to do? And if it does, that's when we make the offer. If it doesn't meet your needs, then no, you should not be buying that property.
Of course.
If you have a short-term vision, then no, you shouldn't be buying that property. But if you have a long-term vision and you see yourself living in this property for years, and obviously life changes and you have to adjust, but I think if there's an opportunity there and you believe it's the right house for you, then you go ahead and you pull the trigger.
No doubt, no doubt. I completely agree. And it's moving forward and with just what you want to do and what you're looking to accomplish, that it's not going to come around and bite you. What I will say is that what's the word I'm looking for? When you are waiting and you're kind of just not moving and shaking, and you're not making traction, you're not actively looking, and these opportunities are flying by, and it's going to put a damper on everything. You have to, if you're in the market and you're looking to buy, you're looking to invest, you have to be diligent with it. You have to stay on it, because if you're not on it, you're not going to see the changes of what's actually going on between the rates, between how volatile the market is with the home prices and how many offers are coming in. So it's one of those things where everything is almost time sensitive nowadays, and it puts a huge damper on it. But very important tip on that is to just always keep a keen eye, always stay in touch with your loan officer, with your realtor as well, and just keep an update on all the pricing when you're going through the tracks on submitting offers, locking your rate especially, and taking the steps you need to do to obtain that loan and that property. Yeah, definitely.
Absolutely. Excellent. Now, let's talk a little bit now about credit and how credit affects your rate as well.
Yeah.
So can you touch upon how credit will impact a borrower when they're looking to get a property?
Credit is everything, Sam. And I say it time and time again, your credit score matters, and I'm going to tell you why. Especially today with these interest rates, you know what I mean? Everybody fears the interest rate, and nobody wants to deal with it. Everybody's always constantly looking to get the best rate possible. Now, what's going to help you get that best rate? It's your credit. Your credit is going to be a huge factor, if not one of the biggest factors, on what's going to allow you to achieve that competitive rate. All of these rates that, you see on TV, and, you'll see like Rocket Mortgage, Guaranteed Rate, Loan Depot, all these companies, right, any company that are blasting these advertisements with their rates. They're basing it off of perfect everything. And number one on that perfect list is your credit.
Yeah.
And even behind us too, you can see here, we have a little bit of an example. Right there, we have a little bit of a scenario priced up. $500,000 loan amount. We're going with a 20% down payment. It's another thing that these other companies base their and advertise their rates off of, is the down payment. And then you have the credit. Now, right there, we have a 720 to 739 showing 7%. Now, what these companies are advertising their rates off of credit-wise is a 740 or even much higher. So now when we adjust it and we put it at a 740, you're going to see it'll most likely go down beneath that 7% threshold. And I don't know, Sam, if you maybe want to show them by clicking it, or just to see how much of a difference it makes.
I hope you guys can see it, but yeah, we put in a $500,000 home, 20% down payment, which will be $100,000 in New Jersey, with a credit score between 720 and 739, and then it gives you a rate of about 7%, 15-year 6.32, and a 10-year at 6.45. So you want me to go ahead and calculate?
Yeah, if you go ahead and just put it at 740 or above, and we could show them
so
the
now
difference.
When we change it to 740 versus 720, we went down.
Went down a little bit. It definitely is worse, as you can see.
740, it did drop from 7% to 6.92 on the 30-year fixed mortgage.
See, not much. It's not much, but like I said, it helps. And a lot of the time, mortgage companies are basing it off of even higher than 740. We're talking about 800s. We're talking about the high sevens, and it is one of the biggest factors. Now, it's not only just about getting the most competitive rate, your credit score. Your credit score is what's going to allow you to put yourself in the most competitive program. There are certain programs for certain kinds of borrowers that you need to have a good credit score to even qualify for it. You know what I mean? And when you go conventional, most lenders are going to they're going to cap you the minimum threshold for your credit is typically going to be a 620, and that's why it's such a huge difference if you're looking at a borrower who has a 690 or a 680 even. You're very still close to not even getting qualified for the program. So that's why there's not much of a window when it comes to credit. You want to make sure you're in the mid to high sevens. That's what's going to get you the best interest rate. That's what's going to get you in the most competitive product, and it's going to open more doors for you to be able to have more options for you to choose from when the time comes. Credit is huge.
Okay, excellent. So now, let's say your credit is not the best, right? But you still want to get a home. What options do people have?
Gotcha. So it all depends, because obviously we know that, I've had people who have come to me and they've had a 400 credit score. I've had people come to me who have been right there where it's like, okay, even for an FHA loan, we can go to 600 minimum. I've had people who are at a 597 or a 598 and they're right there. And typically what happens is that when you have somebody on the lower side, whether if they are way out of the ballpark or if they're right there, the options start to slim. But then it all comes down to, and it matters about who you're working with, because who you're working with really matters, because there's a lot of loan officers who will, when you submit the application and they run your credit and they're like, oh, well, you have a 590, I'm sorry, I can't help you. And then they kind of just kick you to the door.
Yeah.
And we were actually just talking about this before too. One of the very, very good things that I do as a loan officer is that I can actually go ahead and simulate rescores for your credit. So let's just say, prime example, I'll use the borrower I was working with last, won't give any names. We were at a 697, and for a certain program he was looking to accomplish, he was looking to do a heavy cash out refi to go acquire some more properties. For that program, for the money he was looking to take out, well over $1 million, you needed to have at least a 720 credit score. So, it's like, oh man, am I going to turn around and tell this guy that I can't help him? Or no, let's think about how we can help him. How can we get him where we need to be to get this thing done? And that's where these simulators and these credit rescores come into play heavy, because especially when you're right there, how it works is that we have a portal that works with the 3 credit bureaus. And what happens is the computer generated system runs a simulation with between all 3. They check out all of your balances, they check out your any debts that you have, your utilization, and what they do is they simulate it and they process it, and it'll say ballpark, and it's usually accurate. And I've never had it come back and upset anyone. It gives you a estimated percentage score. It'll say, let's just say, if you pay down the Macy's balance from 2,000 to 500, there's a 98 or 95% chance that we can get your credit score from a 690 to a 740 or much higher. And those are precautions that I take every single time with all my borrowers who, when I run their credit, it doesn't meet where we need them to be. So we'll simulate. If that doesn't work, I always like to refer them to a credit repair company that I work with, and they do stellar work. Usually it'll take them about 3 months, 4 months for them to really go hands-on and make sure it is perfect and stellar. But other than that, if I'm dealing with somebody who does have a worse score, there are always other options. If your loan officer turns around and says to you, I'm sorry, you don't qualify for this program due to your credit score, always put your best foot forward and see if there are other programs that they offer, grant programs possibly, that will maybe step outside of the threshold a little bit and maybe go to 580. I know at my bank at North Point, we offer a program called a New Start Loan, and what it does is it actually not only benefits, and you can go down to 580 is our minimum threshold, which is very good.
Okay.
Not a lot of lenders will ever lend you anything under a 600. But we could actually go to 580 with our New Start program. And not only that, you're actually able to still qualify a day out of bankruptcy, day out of foreclosure. It is a sweet program. And listen, you may not get all of the terms that you want with it as in terms of your payment and your interest rate. But
Right.
if you love that property,
You can still find a way to get the property.
we will find a way to get you it.
Yeah, I really love that. I think, for me, that's, something I would like to let more people know about is programs like that where if you don't have the best credit, it shouldn't deter you from, stopping your dream of owning a property.
Of course.
Now, I know you said that's the Fresh Start that you have.
Yeah.
Now, I know a program that, I've worked with a couple different buyers on that, I even really like is FHA, right? So with an FHA, I know it gives you a little bit more flexibility.
Yes, it does.
As far as credit scores and down payments.
Mm-hmm.
Can you explain a little bit more about how an FHA works and what are the advantages of it?
Yeah, definitely. I was actually going to allude into that. So to start, before we even get into the advantages too of FHA, I'll start by saying back to the credit aspect as well. Also, with every lender, it's always going to be different. 9 times out of 10, it's usually going to be 620 conventional, 600 FHA. It could vary, very unlikely so, but that's always another option as well. If you are under a 620 but above a 600 and your lender doesn't offer you and put the FHA option in front of you, definitely make sure you ask about it because that will get you the property. So now talking about FHA a little bit, listen, I love FHA, to tell you the truth. FHA is a great product. It has a bad taste, a bad rep. FHA has a bad rep. A lot of sellers don't like it. Obviously, it takes a little bit more time. As you know, Sam, a lot of people, they kind of get a bad taste in their mouth.
I think some in the real estate circles, certain sellers don't like FHAs, probably because of certain agents may have had experiences in the past where they didn't get to close. Because at the end of the day, agents are concerned about closing the deal and getting it done. And an FHA, a little bit more requirements that you have to meet. But I've closed a lot of FHA loans.
Yeah.
I've closed a lot of FHA deals. I've never had that be the reason why a deal doesn't get closed.
Exactly.
So for me, that's why I really like the program as well.
Of course, and what I will say to that is that, and like you said, there is no reason why you shouldn't be able to close with an FHA loan, or at least in a timely manner as well, because that's where the big thing is who you're working with matters.
Absolutely.
If you could work with a lender, that has a small team that is hands-on with what they're doing, not like if you're not working with a Wells Fargo or a Chase Bank where you can't contact your loan officer or anybody in the departments after 5 o'clock. That's what's gonna put a halt on everything. But who you're working with matters. If you're doing an FHA loan with a team that's gonna work outside of, there's no hours. We are constantly hitting it hard between the real estate side and the mortgage lending side. There is no reason why you can't close in an FHA loan on time. The sellers are still getting their money.
Exactly.
You're still getting your loan, and there's benefits that come along with it. And a few of them are one with FHA, we could talk about the down payment. We can go as little as 3.5%. On top of that, the reason why FHA is good for a lot of people is it benefits the borrowers who are lacking credit, like we were just talking about, because they have lower allowable thresholds. And another great thing is that what battles that is the fact that the pricing for the interest rate actually gets a little bit better. And the reason why is because FHA, there is mandatory mortgage insurance. And when you're paying mortgage insurance, you're deemed less of a risk. So that's what's going to actually offer you a way more competitive rate when you go FHA as opposed to conventional. But I've also seen people who have great credit that love to go FHA because I've had times, I've had people before who have come to me and they've had a 720, 730 credit score. And, rule of thumb, usually we're going to point them into the conventional direction. But they wanted to go FHA, and I priced it up for them, and the rate was astronomically lower, to a point where you were paying way less than where if you were to go conventional. Same down payment, same everything. But sometimes when you go FHA as opposed to conventional, you'll have the MI end up being a little bit more, so it sometimes balances out. So if you have a lower rate conventional but you're paying higher monthly mortgage insurance, it's going to balance out. But 9 times out of 10, FHA is a great product. It benefits all kinds of borrowers.
Now, off the top of your head, do you know, like, we're looking at, let's say, 7% on a $500,000 home right now, what would be roughly around the rate around for like a FHA in that same scenario?
So if you're going off of a 740 to 759 credit score, 20% down FHA, you're going to be significantly lower. I mean, if I could, it's so crazy. I hate quoting things because every day it changes.
Yes,
every single, and I'm not kidding you, it's every single day.
Yeah.
I've never seen it like this before. But I could say anywhere is probably between a full point, maybe a point and a half lower than what we're seeing here.
Yeah, wow. So there's definitely some really good advantages with the FHA, and it's a program that I really like as well. And if it makes sense for my borrowers, I will absolutely tell them, hey, check this out and see if it makes sense for you.
Mm-hmm. And it's all about always, I personally, Sam, I always have done this. Whenever I get a borrower, I don't just say, hey, this is going to be the best program for you.
Right.
I am going to take the time to still look at every other possible option on the table, because sometimes when you think that conventional might be better or best for a certain borrower, you may be wrong, because the pricing that day could be a lot different.
Yeah.
And FHA is a great program. I love FHA, and it shouldn't have as bad as a rap as it does.
No, it's a great program. Yeah. Like I said, really depends on who you're working with as your realtor, who you're working with as your lender. If they're working hand in hand, there's no reason why it can't be closed in a timely fashion.
Exactly.
And get the property under control.
Yeah,
so,
definitely.
Absolutely. Yeah, so those were like a lot of the main topics that I wanted to cover today.
Mm-hmm.
The rates, FHA, what the market's looking like, what we're thinking maybe heading over the next few months. I would like to just, give you the platform now to kind of just share anything that you wanted to share with anybody.
Mm-hmm.
Tell them a little bit about more about your business and your bank and how you're helping people.
Gotcha. So, like we said from the beginning, it's a tough time, to buy, to invest, to do pretty much anything in the market, and there may not be a lot of positive things that I can say right now, but we are helping people still every week, because people still need homes. People still need to invest. That this is people's livelihood. These investors, they rely on this, and people still need homes. So we are still diligently working to get people the best products and the most safe, reasonable financial plans that we can. And at North Point, we have a small team that, just like we were just saying before, and Sam's my partner. We work together very well, and basically our job is, and our passion is just put our heads together and figure out how are we going to make this work, what's going to be the best possible route for this borrower, how can we help you. And I know things are crazy right now in the market. I know that the rates are crazy high, and it's discouraging a lot of people, and it's putting a damper on every aspect of the market, the real estate market. But a few things I will say is one, waiting will still cost you. I think I touched on that a little bit earlier. Appreciation is always more prevalent than depreciation in the market. And if you have something good down your scopes, it's always smart to pull the trigger. Two, a huge thing is that the competition has died down a lot. We started seeing the home prices come down. There are less offers on these properties, and it's opening up doorways for people who, if you really love that house, if you really love that investment, the competition isn't as where it used to be. So it's going to make it easier for you to get that house. Other than that, it's like and I will always say this, it is my rule of thumb, it is the biggest thing and we've said it time and time again, it is you marry the property, you date the rate. And a few things that I will say too is when you have something that you love, you should do anything in your power to achieve it. If you have a goal and you know it's going to work, take every necessary precaution, take every possible option into consideration. Put your loan officer to work, put your realtor to work, and put your heads together. Form a team to figure out how you could accomplish that goal. What is the best route to accomplish that goal, and just work together and get it done. It's the biggest thing. And just a couple things that I will say too. When we were talking about how we wanted to talk about a little bit of housing hacks or mortgage hacks.
Yes.
A few things that I will say is in this kind of a market too, we're seeing less competitiveness. But this isn't really a hack. Well, I'll start off with a tip. I call it the 10,000 rule, and I just want to put this out there because I've seen so many times where people have just lost the offer on their house due to crazy bids. And the 10,000 rule kind of works like this. With every $10,000 that you're borrowing on your mortgage loan, it's only going to be a $50 to $60 monthly payment difference. So if you really have a property that you love, don't lose the property and the offer over $50 to $60 a month.
Yeah.
Like we said, you could always refinance. You could always figure out a way to get that payment down. $50, $60 a month to get you that dream home that you're passionate about. That's going to make you feel at home. Yeah, it shouldn't be in the question. And just a couple things too. A couple little hacks on the mortgage side is obviously nobody wants to pay closing costs. And closing costs are always split between the buyer and the seller. Nobody wants to pay them. So one thing that I've done before in the past, and that I see a lot of things happening more like this now is people rolling the closing costs and trying to eliminate them. So there's two ways you could do that. The first way, the more conventional way, is to you could communicate with the seller, and this is where the realtor could step in and help you big time. Ask the seller to increase the purchase price. You can match whatever that margin is. So if you're looking at a property, the asking price initially is $300,000, right? Closing costs are typically anywhere between $10,000 to $15,000 for the loan, depending on your program and your loan amount. It's usually between that threshold. So if you ask the seller to increase the purchase price of the property, and you can get a seller concession for that exact amount, and put it towards your closing costs, and if not get rid of it all, a great amount of it. That's more of a conventional way to do it. Another way to do it as well is you could also ask your lender to increase your interest rate just slightly. And I know it kind of seems a little scary to say so, but a few basis points on your interest rate mortgage pays a lot. And what you could do is by doing so, with that margin, with the basis points, you can ask for a credit back, and that could also get applied towards those costs. So we know everything's tight right now, rates going up. Everybody always wants to spend as minimal as possible. So that's just a small little technique or hack, if you would like to say, to save yourself a little bit more money when it comes to buying a house.
Absolutely. Beautiful. Yeah, I love that. House hacking, I did a video on it a little while back. When you're dealing with a multifamily property, live in one unit, rents out the others, use the rental income to help you qualify for the mortgage. That's a great way to get a hold of your first property. You're going to be able to use the income from the property to help boost your income to get you approved for the loan. And now you're going to be able to hopefully get a little bit of, income every month to help you pay your mortgage and things like that. So, house hacking is something I would highly recommend, especially if you're looking to become a real estate investor. You can usually get your first property like that, and then you kind of just snowball from there, use the same strategy on your next property, and so on and so forth, and you can build a nice little portfolio like that.
Definitely, yeah. It definitely helps with the what you're budgeting when you're looking to get to that table.
All right, well, that's it for me. Again, my name is Sam Erekeosima. Nick, thank you so much today for joining us and really sharing some of your knowledge and your expertise in the field. You know, guys, I've worked with Nick on a few deals, and he's excellent at what he does. He actually really cares, which is why I like working with him. He'll just do whatever it takes to make sure that, you know, in his power to make sure the deal can get done, and just a really good partner to have. And I appreciate you.
Yeah,
for coming
thank
in
you,
today.
Sam, and likewise, you know, Sam here. We, like he said, you know, we've worked together in the past, and you know, we plan on working together consistently.
Yes.
And you know, this man right here, he knows what he's doing. If you want a realtor that has your back and that's going to point you in the right direction, you know, you're looking at him. And you know, we're the dream team over here. So anything you need, feel free to reach out. Thank you again, Sam. It was a pleasure.
Yes.
And definitely looking to make some things happen in 2022
Yes, sir.
before we have it.
All right, guys, that's it. We'll catch you next time.